Dog's barking. That can only mean one thing. The mail's here. Yeah, we got another Reddit mailbag episode. And just a reminder while you enjoy, this is not advice. I'm not your advisor. Welcome to another Reddit mailbag episode, and this time we got a peanut butter stout with us. Make sure we're okay along the way. I actually reached out to the mods of this subforum saying, hey, I thought maybe the readers would want to have me, post and reply and let them know that I've answered their question in a video. And they said, absolutely not. No promotional posts. And because my name on Reddit is Buck Talk, any posts that I make ipso facto would be advertising. So no posts. You won't see any posts from Buck Talk on the personal finance subreddit. Let's get right in. All right. Start with CKim82. 40 to 50% down on mortgage. I hear conflicting views on whether or not it's a good idea to put this much down on a house and wanted to reach out to this community. A bit of background. Shopping for a new home in the near future, and I have about $150K left on my current mortgage. Anticipate to sell for about $600, netting $450. Is it wise to put all that towards the next house if it's going to cost $850 to $950? You'd like to have a reasonable monthly payment. That makes sense to me. You max your 401k and have a decent amount in online savings. I should probably invest in some index funds, but you don't know anything about stocks. I don't see anything wrong with making a big down payment, especially if that's going to mean that it's more comfortable to make the monthly payments. Mortgage rates are probably closer to 4.5% or 5% now, especially if you're not comfortable investing it, investing dollars outside of your 401k. Putting it towards the mortgage seems just fine. You probably should spend some time getting comfortable with what you do with after-tax investments. Otherwise, you're just going to end up with an absolutely enormous savings account. You probably already have one based on this post. So you should figure out what that is. That doesn't necessarily mean you need to follow this subreddit's advice and put everything in like the S&P 500 hyper aggressive like that. But you should check it out. Where to invest when you want rock solid safety from Don't Eat My Tomato. All right, won't eat your tomato. Hi all, I'm thinking about buying things like US bonds or ETFs that buy bonds. What indications should I look for in the prospective reports or past behavior? Some of these bond investments that would make some more secure than others. You're looking for maturity expectations 6 to 18 months. Portfolio percentages, 40% equity, 60% bonds, with approximately half in low yield rock solid bonds and half in higher yield bonds. You have a brokerage account, so you can also do money markets and CDs. You have noticed they usually have too low of interest rates. I don't know what too low means, but I'll take it to mean you want more return than that. You're fairly young. Your goal is to build a portfolio to be self-sustaining. You consider yourself a passive defensive investor. Okay, so I think you're saying that your portfolio outside of this is 40-60, which is pretty conservative. So, I would also consider you a defensive investor. 2 or 3 main things to look at when you're looking at a bond fund. So number one is the issuer. Money market funds are very safe. So you're not going to get a much higher yield if you go with a really safe issuer like CDs, which are what banks pay, or treasuries, which is what the U.S. government pays. If we're talking about a taxable account, then municipal bonds, and that's like municipal bonds not in a state like Illinois or New Jersey. But those are very safe as well. They're backed up by the state. And so that's the first thing to look at. If you start going into corporates or other countries, you're taking a little bit more risk. Then the other thing, and you already said what the maturity expectations you want is the time to maturity. If you buy an ETF that buys 10 or 20-year bonds, and your plan is to sell this thing in 18 months, if interest rates move, and the value of that thing might move. What you should really do, I think, is to find something that's the right amount of risk for you and go and check year by year returns and figure out if any of those movements were too much for you to handle. And then, of course, just because something only had a down 5% year doesn't mean next year can't be down 10. But the important thing to understand is the duration on any bond fund tells you how susceptible it is to interest rate movements. Something has a duration of 10, you expect it to go up or down 10% when interest rates go up or down 10%. And that's not respective. That's the opposite of respective. If interest rates go up 1%, it would go down by 10%. And if interest rates were to go down by 1%, that 10 duration bond fund would go up by 10% to a first approximation. That doesn't take into factor the risk that you're taking. With a U.S. Treasury, you're taking basically none. With a CD, you're taking basically none. With a Tesla bond, you're taking some risk. So I'm not sure exactly what you're looking for. If you're looking for something with way more yield than money markets, you're probably going to start taking more risk than someone that's 40-60 wants. But take a look at duration, make sure it matches up, and just think about what you want to buy. Should it be treasuries? Should it be Coca-Cola? Should it be what? And then make sure that the taxability matches where you're investing it. If you're putting something in an IRA, you don't want it to be a municipal bond because it's already tax-free anyway. All right, from Miss Link. I am soon to become a grandfather. That's a weird name. I would like to put some money into a 529 for the baby. Is it best for me to create a 529 in the baby's name, your son's name, give the cash to your son and let him put it in a 529 for his kid? Well, the first thing is you can't do it until there's a social security number. So you'll have to wait for the baby to be born. But after that, I'd say it depends mostly on your son and your daughter-in-law. If they're the kind of people that wouldn't want to set this up themselves, they might not figure it out or have the time or the bandwidth and they would appreciate it, then go ahead, do it. You'd want the baby to be the beneficiary, but you could make you or your son be in charge of the dollars, and you could transfer that. If your son is the kind of person that would want to handle this themselves, they're probably not going to want to have a bunch of different little 529s rolling out there, so probably just give them some cash. If you're thinking about doing more than either $15,000 or $30,000, then you're going to want to consider putting it straight into the 529 instead of doing a check. And I say 15 or 30. If you're married, it's 30. If you're not, it's 15. Because 529s, you can put that all in there in 1 year, and it's not going to end up being a gift. If you put more than 15 or 30 as a check and you give that, then you've got to check the box on your tax return and say, I use up some of my lifetime gift exemption. Just adds a layer of complication that's probably not necessary. All right, so from the RZA001, about to graduate with massive dental school debt, $550K, holy crap, how much do dentists make? And begin a residency, need a plan. And then there's a list of the loans. I'll scroll down here. Oh, it's nasty, look at those. Current principal, 500, current interest, damn. It was painful to type up, it was painful to read. Here's the deal. I'm doing a 1-year residency. You'll get $60K benefits. You'll be employed. You think you'll make about $150. Each year will come with additional pay. The plan later is to own your own practice and then a much greater income, basically starting from scratch. Okay, so here's the thing. 550 is a lot of debt on 150 of income. The rule of thumb that gets thrown out a lot, and I think is frankly pretty good, is that a 2-to-1 ratio is about as high as you can comfortably go. So it's not like it's impossible to deal with the fact that you're like closer to 4-to-1 than 2-to-1, but it's not going to be comfortable. And the other people coming out of dental school with less debt or no debt, if any of them exist, they're going to be living much higher on the hog than you are. What you're going to have to do is basically, if you can live however you're living on 58K, once you start making 150, you're going to be able to make really good dents into this. If you live on 58 and then all of a sudden you're making 90 more, that'll be New York, if it's still New York, probably 50 after tax. And I mean, that 50, you could pay this thing down. You'd have to run the numbers. It'd probably still take 20 years to pay it down 50 per year. But that's pretty much what you have to do. as you start making more, obviously you can pay more and more. And if you start making 200 or 250, then it'll be a lot shorter than 20 years. But this is a lot of debt to only be making 150. So if that's the baseline, you're going to have to be living like you're making 58 for the foreseeable future. Where to put 90K for a year or two? My wife and I hope to buy a house in 1 to 2 years' time and would like to park the majority of our down payment in the meantime. Access to the money is not necessary, although knowing about options that allow access, like standard locked-in CDs. You're not contributing to retirement. Primary goal is to buy a house. Okay, so CDs are a good one. If you buy them straight from your bank, like you said, there's a lockup. In a lot of cases, you can buy CDs like directly through a brokerage firm, like Schwab or Vanguard, and those you could sell. Now, you're not locked up, but there may not, you may still lose money selling it. There may still be a cost to that. There's not a lot of people going to buy really short-term CDs, so it's not like a free option. But a CD is a good thing to look at. I probably stay away from a 1 to 2 year CD unless you're really sure about the time frame. My experience, as soon as you start looking, you're likely to find something. Money market funds are pretty much the easy answer here. I mean, you'll be getting 2 or 2.25%, but the money will always be there. You'll know what the yield is. There's almost zero risk that it's going to change price at all. That's what makes the most sense. All right, Cool Man 2311. Different asset allocation strategies for multiple accounts. Hi, I want to know, does it make sense for anyone to have different asset allocation strategies for different accounts? Some securities make sense in tax sheltered accounts versus being in a taxable account. Yep. For my Roth IRA, I am aiming to do as followed. 50% stocks, 30% bonds, 20% real estate. Okay, and for your taxable account, 60% stocks and 40% bonds. From my understanding, many individuals talk about asset allocation in terms of your whole portfolio. I feel that it is much more convenient to apply different allocation strategies to different accounts as needed. It makes no sense to hold REITs or regular bond funds in taxable account, and therefore my allocation will be thrown off as a whole as a result of this change. Yeah, I mean, I think people just talk about them as a whole because that's like what actually matters. But yeah, there's definitely asset location, meaning in what account do you put which assets, is a pretty big deal. And it can make a pretty big difference to the value of your accounts over time. So you're thinking about it exactly right. And I think most people just talk about it that way because everyone has different accounts and different balances in different accounts. So it's much easier to manage things all the same. Most people aren't breaking things down the way you are. They're not holding REITs specifically. Usually they're just owning them as part of the index. So I think that's what's going on. I don't think what you're doing is unusual. I think it can make sense. That's it for this episode. Big shout out to JKCL009 for rating us on iTunes and on Jenkins for the YouTube comments. Those are great. Keep them coming.